Good morning, and always a pleasure speaking to you. What would your own expectations be first up? And also, are you expecting any kind of liquidity measures? If yes, what would they look like?
Morning, Reena. I think this time we are with the consensus that we're not expecting any action on the rates from RBI. But you're right, there is a very strong case for RBI to at least address the excess liquidity in the system, because clearly with the kind of upside risks which RBI had highlighted in the last policy, a sustained excess liquidity in the system can actually influence inflationary pressures. So I think we do expect a combination of measures. There's been a lot of talk around, the standing deposit facility as an additional tool to mop up this liquidity. But I think till there is an amendment to the RBI Act, in the interim period, we expect a combination of MSS and the continuation of, the variable rate repo measure from the LAF.
So that would mean, Amandeep, a no action policy, nothing on rates, nothing on liquidity.
No, Lata, actually on liquidity we do expect something. I think the street still feels that RBI may tolerate excess liquidity for another quarter. But like I said, if we do see some inflationary risks in the second half, then clearly RBI has to act now and not wait for the second quarter of, financial year 18.
So what
so I think there will be some announcement.
Sorry, go ahead.
So I think there will be some announcements around that. Like I said, the most commonly talked about issue, since it was brought up by the Ministry of Finance, is around the SDF. And I think they may actually pencil in or some outline on how they'll go around, possibly implementing it if they do intend to. Otherwise, the standard tools are still available. They did not really issue MSS in the later part of last quarter. I think they could actually come back to issuances of MSS in the current quarter.
Okay.
So I think that's one expectation from our side. Okay. And then, of course, like I said, the variable rate reverse repo, term repos still do.
What should dealers worry about when they announce if they announced that they are planning an SDF or there are plans? Will that be bond positive? Do you also expect them to tell you whether the rate will be above the reverse repo or below the reverse repo? Basically, what is in it for a bond dealer? Is it going to be 6.55 at the end of the policy? Is it going to be 6.75 at the end of the policy?
I think some measures to mop up liquidity may not enthuse the bond markets. At best, maybe you could see a reversal of a few basis points, nothing meaningful in our view. I think the markets are really right now moving on slightly different perspective of, looking at what RBI does possibly 2 quarters from now. But at the short end, clearly, we do see markets are still not really, believing an expectation from RBI that they'll actually do something on the liquidity front. So you actually still see, the short-term, papers, whether it's a 3-month treasury bill and so on, actually trading well below the policy rate. I think somewhere RBI has to send a signal to the markets that, the policy rate, which is currently the repo, is sacrosanct, and there is a meaningful, alignment with that rate going ahead. Unless that happens, I think the markets will continue to trade well below the repo as far as the short end is concerned. And I think at the long end, like I said, the driver is a little bit different from the immediate liquidity.
Okay, Amandeep, good morning. And what about the slightly longer trajectory in terms of once the policy is over? We've seen such, violent moves in the bond market. Going forward, what's the likely trajectory?
So I think we still stick to our broader outlook on the rates, which essentially does pencil in an upward bias, simply because, like I said, some of the key drivers have not changed. We've seen a very strong rally in the 10-year yields in the recent past. But I think, like I said, this is more of a temporary reprieve for the markets. The key drivers that I talked about just, around the Fed policy meet still remain. I mean, Trump is still in power. The Fed has not turned dovish. Their dot plot still remains very much in the play. And finally, global growth is picking up. So, while you may have seen a bit of a retracement in oil prices and you may have seen some commodities move down a bit, but at best, I would really rate it just as a small midterm correction. It's not really changing the broad macro outlook on global growth. So I think commodities will move back. In fact, oil has again moved back to $54, to a barrel, something which sort of had moved to as low as $51 odd. But I think those trends will persist for the rest of the year. And then, of course, domestically, like I mentioned, we still have some upward, bias for domestic inflation. GST is going to be implemented. That, in our view, could be marginally inflationary. Then of course renewed concerns around the monsoon outlook, given the fact that El Nino has again been talked about. So I think the combination does not, in our view, enthuse us to be very bullish on the rates, and we would prefer to trade with caution right now.